As we approach a pivotal moment in the financial landscape, stock futures are showing minimal movement, setting the stage for a significant inflation report that could influence market dynamics. On Friday, futures for the S&P 500 experienced a slight increase of 0.06%, while those for the Nasdaq 100 dipped by 0.1%. Meanwhile, futures associated with the Dow Jones Industrial Average saw a modest rise of 81 points, translating to a 0.2% gain. Investors are keenly anticipating the release of the Personal Consumption Expenditures (PCE) price index for August, which is scheduled to be unveiled today. This index is particularly important as it is the Federal Reserve's favored gauge for measuring inflation. Economists are predicting that the data will indicate a rise in inflation, and the markets are currently factoring in the likelihood of 2 quarter-point interest rate cuts in the upcoming meetings of the Fed, aligning with the central bank's own forecasts. However, the market's reaction could be significantly influenced by this report, especially following the release of robust job data earlier this week. The jobless claims report showed a decline to 218,000, which was well below expectations, raising concerns among investors. Many fear that a decrease in jobless claims might suggest a resilient economy, potentially giving the Fed less incentive to lower interest rates. On Thursday, all 3 major U.S. stock indexes experienced declines, and the yield on the 10-year Treasury note climbed to 4.2% at one point during the trading session, driven by the latest economic indicators. In the realm of artificial intelligence, key players such as Oracle, Meta, and Tesla also saw their stock prices retreat. Oracle, in particular, faced a 5.6% drop, as some investors expressed growing apprehension that technology valuations may have escalated too quickly, raising questions about the stability of the interconnected AI sector. For the week, the S&P 500 has fallen nearly 0.9%, while the tech-heavy Nasdaq Composite has seen a decline of about 1.1%. The Dow Jones Industrial Average has also dropped by 0.8%. Despite these setbacks, some investors remain cautious yet optimistic, looking for long-term buying opportunities. Andrew Sliman, who leads Applied Equity Advisors at Morgan Stanley Investment Management, mentioned that he would consider using any market weakness as a chance to increase his positions in technology stocks. The market was vulnerable to a pullback, and since tech has been a leader, it's the most susceptible to these fluctuations, Sliman explained to CNBC. "I wouldn't panic over this situation. Any pullback, or even a more significant decline in speculative stocks, can be beneficial for the market. When speculation runs rampant, it's not a positive sign for the long term." In after-hours trading, shares of Costco and Concentrix were notably affected by their earnings reports. Costco's stock fell approximately 0.9% after the warehouse giant announced its fiscal fourth-quarter earnings and revenue that surpassed analysts' expectations, buoyed by impressive growth in both membership income and e-commerce sales. The company reported earnings of $5.87 per share on revenues of $86.16 billion, while analysts had anticipated earnings of $5.80 per share on revenues of $86.06 billion. Conversely, Concentrix's shares plummeted nearly 22% in after-hours trading after the technology and services firm fell short of earnings expectations and revised its forecast downward. The company reported adjusted earnings of $2.78 per share, below the $2.87 per share that analysts had predicted, although its revenue of $2.48 billion did exceed the consensus estimate of $2.46 billion. Additionally, Concentrix announced an 8.2% increase in its quarterly dividend to 36 cents per share. In a related note, Tom Lee, head of research at Fundstrat, shared his insights on the market's outlook regarding potential Federal Reserve rate cuts. While the market is currently pricing in 2 additional rate cuts this year, Lee suggested that even if the Fed opts for just one more cut, it could be interpreted positively. He stated, "If the Federal Reserve only implements one rate cut by the end of 2025, I believe the markets would view that favorably, as it would indicate the Fed is cutting rates in a strong economy rather than a weak one." Lee's remarks come in light of a slight adjustment in market expectations for a quarter-point rate cut, following the release of lower-than-expected initial jobless claims. He cautioned, We know that the Fed has been slow to ease due to the imputed shelter inflation. But the reality is, they should have started easing sooner. We need to be cautious. Just because it takes time for effects to manifest doesn't mean we should initiate a new cycle of rate hikes. I believe the markets will see through that. As we navigate these complex financial waters, what are your thoughts on the current state of the market? Do you agree with the sentiment that a pullback in tech stocks could be healthy for the overall market? Or do you believe that the Fed's actions will lead to more volatility? Share your opinions in the comments.